Hello friends, welcome to another video on technical analysis. So in this video, we are going to talk about Elliot wave, the first wave. We'll be discussing only the first wave in this video, and we'll see how the first waves are formed or how they can be marked correctly. Okay, and what are the chart patterns or what are the patterns that can form before the first wave, or many people they may be counting the first wave wrongly. And for Elliott wave, if you count the first wave wrongly, that means you are counting the whole wave or the complete cycle wrongly, right? So that Elliott wave is such a tool that if you are not doing it correctly, then it it will have a lot of consequences, right? So you will make a lot of mistakes, and that will reflect in your trading decisions, right? So it is very important to understand that where the first wave begin, or how you can mark the first wave correctly. Okay, so I have seen I've seen many chart patterns, and over the years, I've identified few patterns that I find myself useful while marking the first wave. Okay, so we'll go through the all these chart patterns, and we'll see in the upcoming video. I'll show you some real example of these chart patterns, but not to make the video too long, too big, I will just go through the theory part. Okay. So first wave is, as we know, Elliott wave. It says that the market moves in a cycle in which 5 waves to the upside and 3 waves to the downside. That is a corrective wave. So wave 1, 2, 3, 4, 5 will mark as the impulsive wave, and ABC will mark as a corrective wave, right? So let me draw. So if we say that this is the first wave, say this is the second wave. Okay, say this is the third wave, and say we have some fourth wave, and this is the fifth wave, right? And followed by that we have wave A, wave B, and wave C. So there are different kind of patterns that form as part of corrective wave, or form as part of fourth wave or second wave. So for the corrective wave, I've already uploaded a video. For Elliott wave corrective wave, you can watch that video, and I'll talk more about the second or third wave even when when I will discuss each wave in details. Okay, so this is the first wave, so we'll be talking about the first wave. So that is very important to understand how the first wave is forming, or when, or how you are, whether you are marking it correctly or not, because based on the first wave, you are going to mark all the waves, right? So if your first wave is wrong, that means you are going to mark all the other waves incorrectly, right? So we'll see, just a minute. Okay, so as part of the first wave, I find these patterns very useful in marking the first wave correctly, and these patterns are very important, and they form on every instrument on any time frame. So if you find these patterns and you are marking the wave, say even for a 5-minute chart, you can find these patterns and you can start marking the waves uh, from starting from the first wave. Okay, so the Elliott wave is independent of the time frame. It is independent of the instrument. That means you can count the Elliott wave on any instrument on any time frame, even on 1-minute chart or even on the monthly chart, right? So that is in Elliott wave is basically independent of the time frame or the instrument. It can be a stock, a commodity, or a currency, a forex pair, anything. Okay, so it can be on any instrument or on any time frame. Okay, so say the market is okay, so let's say the market is trending down. We have lower lows and lower highs. So every time the market is making a lower low and a lower high, right? That is the basic structure of a downtrend market, right? So we'll have this lower low and lower high, lower low, lower high. So once the market is trending down, what you can do to count the first Elliott wave, you have to wait and watch for these types of pattern that are forming, right? So say I'm willing to buy in a downtrend market, but catching a downtrend market without any proper strategy or without any proper setup is catching like is like catching a falling knife, right? So every time you try to buy, you put your stop loss. You see the market is going up, you buy, you put your stop loss just below this, the market takes it out. Again, you buy, you put your stop loss below this, the market takes it out. Same thing goes and goes, right? So it is very, it is never advisable, right? I will never recommend you to, right, to catch the bottoms because, or to catch the tops, because that are, it will take years for you to practice those kind of movements. And if you're a new trader, you should never be you should never be trying hard to catch a bottom or to short the top. Okay, so that is very important. Like if over the years you will learn that it like technical analysis is not a subject that you can learn in few days or few weeks, and it will take until unless you practice these things by yourself on the charts, you will not never learn. Like, so whatever video you watch, whatever the books you read, you have to practice, you have to see themselves, like see by yourself on the charts. Okay, so once you start identifying the patterns, you start working on those, you start observing those patterns, you will improve every day, you will improve. Okay, you learn new things and you will improve. Okay. Okay, so let's go to this one, consultation. Okay, so say the market is trending down and we are forming a lower, market is forming a lower low and then lower high every time. Okay, so there will be a time when there will be some consolidation going on, right? So you will see the market is consolidating in some channel, right? So it can be a horizontal channel, or even it can be, say, um, inclined or declined channel, but that will depend on the condition. I'll talk about those things later. But say the market is trending down and you see a consolidation is going on, right? So you have to wait. You cannot, you should never try to catch these bottoms, right? You wait for the market, let the market show you something, and then you take the trade, right? You should never be very much uh, eager, or you should not trade like based on the assumptions, right? So you should always wait for the market to give you some hint, to give you some kind of confirmation. Based on that, you are going to take the trade, because based on that you will find whether the strategy, whether the setup is working right or wrong, right? Whether it is working properly or not. Because if you do not have a setup or a strategy, then you are never going to improve in trading, right? So wait for the setup, wait for this consolidation to complete. And once the consolidation has completed, say I see a breakout happening, right? So that would mark as a first wave of this cycle that is going to form, right? So once you see a breakout, let the breakout, let the breakout retest the line, or say even the middle line of the channel, and you start buying based on the setup or the strategy that you have deployed. And once either you can start buying at this area if you get a buy signal, or you start buying above the high of this candle or this move, right? So that will be the first wave of the cycle that is going to form. Okay, so you will see that the market has started forming these kind of cycles, right? So that will form a cycle. Like a cycle can form on 5 minutes chart. That 5 minutes chart cycle will form a first wave and second wave on a higher time frame. So that is the fractal nature of Elliott wave theory. Like a cycle which is forming on lower time frame will form a bigger cycle on a higher time frame. Okay, so so that will be the first leg or first move or the first wave of this cycle that is going to form, right? So once you see a breakout, what you can do, you wait for the market to retest the breakout, you get a buy signal, you take the trade. Your SL would be below the low of the this wave, because as per the Elliott wave rule, the the second wave, which is this one, should never go below this line, right? So once it started going below this line, you get out of the trade, or you get a stop, or say you are using a setup which is pointing towards sell direction, right? So you should quickly get out of the trade. Do not wait for the market to turn around, right? That is the worst trading style, because if you are waiting for the market, you will be waiting for the lifetime. Like that is not going to happen, because that is the way market works, right? So if you are stuck in a trade, cut your losses, get out of the trade, revisit the chart, replan the chart, like replan your strategy, work out your strategy, and take the trade again, right? So trading with stop loss is very important, and once your stop loss is taken out, you must get out of the trade. Okay. So say you have taken a buy setup or your buy trade based on this breakout, and once the market has started going up, what you can do, you can move your stop loss to either break even, or you can also move your stop loss to the to some profit, right? And let the market form the cycle. And once you are experienced enough to count the wave properly, then you'll find that this setup is very good, and it forms on most of the instruments. Okay. So that will a consolidation, say a market is trending down, a consolidation is forming, and you see a breakout and you buy, that will be the marking that will mark as the first wave. Okay. So either the breakout can happen from the middle of this channel also, right? So if this is the channel, a breakout can happen uh, like this way. Okay. Just a minute. Okay. Okay. So a breakout can happen like this way. Right. So you'll see a breakout happening from the middle of the channel, and that will mark as the first wave for you. So once you see the second wave, or you wait for the market to pull back, because the market often like to retest this edge of the channel, or save in the middle line, right? So you see the market is retesting this level, and you get a buy signal, you take the trade. And for the initial target, what you can do is very simple. You can simply um, select the first move and simply project the first move to this length. So that will be the basic initial target for you, because if I'm buying a stock and I'm getting a profit of 100 rupees, then the next time I buy, I would like to make another 100, right? So that is the basic idea that most of the participants are using. Like if they are day trading, or say a positional trader, even in that case, they like to um, get a profit based on the predefined level. So say I'm getting $100, then the next time I buy, I would like another $100. So that this setup, like this approach, is very useful, and it often, like it in most of the cases it works, right? In every case, almost every cases it works. If you project the length of this first wave to this retracement zone, you will get the target for your trade, right? So that is the basic setup. So this one is for the downtrend. Similarly, it will form the for the uptrend. Okay, if the market is trending up, then 1 minute. Okay, so if the market is trending up, then you will have this say higher highs and higher lows, right? And once this is formed, you will see that there are some consolidation going on, and based on the consolidation, right, you have to wait for the market to give a a breakdown of this consolidation range, and you wait for the retracement to retest, wait for the market to retest this line or this uh, consolidation zone, and you take the trade. So that is the first wave based on the consolidation. Okay. So this one is, let me remove this one. Okay, sorry. Just to remember, I will I'll draw it again so that you can identify the differences in all four patterns. Okay, so right. So this is the first wave. Okay, so just for the convenience. Okay. So head and shoulder is almost like same way, but there will be a inverted head and shoulder formation in the case of a downtrend, and a head and shoulder pattern in the case of an uptrend. Okay, so say we have this move going on, and we'll see a head and shoulder pattern that is forming, right? So this way. So once this neckline, say this one is my neckline. Okay, so uh, just for this case, okay, say this one is my neckline. Okay, and once I see a breakout, then I'll wait for the market to retest, similarly to retest the neckline, and then we can buy, right? So that will mark as the first wave, and we'll see the inverted head and shoulder pattern in case of a downtrend. And for the case of uptrend, we'll see a head and shoulder pattern. So simply mirror this pattern to the upside, you will get the formation of head and shoulder pattern on the top of the fifth wave of the uptrend, and the downtrend can begin, right? So that is the head and shoulder pattern. So that will mark at the first wave. Okay. So next one is double bottom or double top. So similarly, we have the move going down. Okay, say the market is trending down, and we see a double bottom, right? So similarly, I will draw this line, or and I'll wait for the market to give a breakout to give me some confirmation that will be my first wave. And based on the further movements, I can count the Elliott wave cycle. So that is a double bottom. Similarly, you will get a double top on the in case of uptrend. Like when the market is going to reverse, you will find in some charts that a double top has formed on the top of the price level, and once the pattern has been broken, like the market started going down. So that is a um, double top and double bottom pattern for counting the first Elliott wave. Okay. The last one is very important, breakout of a channel. So say I have this channel forming in case of a downtrend, right? So say the market is right. So it can be okay, 1 minute. It can be a channel, right? So it can be a channel, and Sorry, it's taking some time. Okay, so say you have, say I'm just drawing this channel. Okay, so I get a channel based on the price movement. I have, like, you will find multiple uh, uh, multiple videos. Even I've made some videos on the trading with triangle. In that pattern, also in that video, I've also talked about the channel. So we'll see when we have a channel forming and the market is trending down in the channel, you will find that a move which was quite strong has broken out of the channel, right? So remember one thing, like Elliot wave, the first wave will never begin or will never form out of a declining channel, right? So that is very important to know and very important to remember that a first wave will never form um, in an inclining channel, a declining channel. Okay, so you see a move that is breaking out of this channel, you wait for the market to retest this edge of the line, and that will mark as the first wave for you, right? So that is the first wave, not this one, because if the market is trending down, uh, a swing high from a lower low, this one is a swing high from a lower low, will never form the first wave. Okay, that will find some resistance, it will come down, and once it start um, touches this line, or say the middle line of this channel, you count the first wave. So that is very important when you are counting the waves on a smaller frame, and you are counting the waves on a higher time frame. So you have to see the channel, you have to count it very carefully, right? You cannot count the wave, the first wave when the market is in a declining channel. The first wave in a consolidation zone can be counted because it is coming directly from the consolidation zone, and this one is like a horizontal channel, and there has been a strong accumulation or distribution going on based on the inclining or declining channel, and this one is the first wave. A first wave is an impulsive wave. That means there was a strong buying activity or strong selling activity happening at the first leg of the movement of the market. Like, so if there is strong buying activity, that means there will be some downside to the market, or there will be some consolidation zone, and there will be strong buying activity. That activity will mark as the first wave for the complete Elliott wave cycle, right? So you have to see the movement of this first wave. You cannot think of this as a first wave. Say, even if this is in a channel, uh, what is happening? Let me draw again. So say if you are okay, say even if you are drawing over here like this way, that is not your first wave, right? That is not your first wave. The first wave has to be completely out of this channel, right? It cannot be, the first wave can never be inside this channel, right? Similarly, the first wave can never be in this area, or even for this bottom area, this double bottom, the first wave cannot be in this zone. For this declining channel, the first wave cannot be, should never be, actually. You should never count based on that, because that is what I've learned over the years, that the first wave should never be counted from the inside of this channel, right? You wait for the market to give a breakout, wait for the market to retest this channel, and you start counting your waves. That is the best way to count the waves, not counting the waves inside the channel. Okay. So that's all for this first wave, and we will talk, or we'll see more example of this first wave on some real charts, and we'll see these patterns that have formed, and how we could have identified those patterns, how we could have traded those patterns. Okay, so that's all for this video. Hope you liked the video. Do let me know in the comment section, and do subscribe. Okay, happy trading, and bye.